We're still anticipating a couple of rate cuts in H2, but indeed the economic data and some of the stubbornness of inflation may mean that some of those expectations will shift a little bit in time. We'll continue watching that space. I think the resilience of employment, the strength of the economy are all good signals for a soft landing and therefore good signals for the outcome for the economy. But indeed, they are also supporting a little bit of that stubbornness in inflation that we're seeing.
In the past, a lot of us have spoken about the central bank being the central bank for the world, not just the United States. And you look at the global environment thanks to HSBC's business. Is the Fed in danger of breaking something?
I think, I have a huge respect for the job of central bankers around the world because it's an amazingly complex and difficult mission that they're entrusted with. But we have to trust that the best decisions are taken with all the available information, therefore minimizing the risks of breaking something. This being said, you're never out of that risk.
How much harder will it be for HSBC to increase revenue in an environment when rates are being cut?
Well, yeah, I mean, look, clearly, we have been one of the beneficiaries of the rate cycle, but let's not forget, we made, some of these, revenues on rates because we have an enviable balance sheet. We have a very strong balance sheet. We have a fantastic deposit franchise. We have a fantastic financing capability, and it's the strength of this balance sheet and the customer franchise we have, which allowed us to benefit also from the rate cycle. In a rate environment where we're seeing a reduction in rates, and with the assumption that the economies remain resilient, and we're clearly seeing that case in the UK, for instance, there is expectation, we can see it from our clients and engagement with our clients, there is expectations that you'll start seeing activity pick up, financing requirements pick up, and therefore the volume side of the earnings will pick up, mitigating some of the downward pressure that's coming from rates.
In our interview, the HSBC Group CFO also touched on his expectations for the world's second largest economy.
When we look at China, we're looking at a major economic transition which is taking place, which give us very strong grounds to be very positive about the medium and long-term outlook. So just taking kind of China's development for the last couple of decades has been heavily reliant on infrastructure, heavily reliant on real estate, heavily reliant on exports. China's maturity in terms of economic maturity at this stage means that it is the right time to transition into what more mature economies are, which will be more enabled or reliant on consumer, more enabled and reliant on services, more higher value products, sustainability related products, EVs, batteries, we've seen that, but obviously a lot of the renewable generation capabilities being produced in China. Now that transition will mean that China will avoid falling in this middle income trap and be able to continue the growth pattern. Some of the Western economies have gone through those transitions in their past. China is going through that transition today. That gives us a lot of positive outlook for the medium long term for China.
You're avoiding short term. You're avoiding short term here. Does that mean short term is going to be a bumpy trade?
There will be naturally some short term challenges to go through, and the short term challenges may last a few quarters or a couple of years, but you have to go through those challenges to get out of it in a much better position to be able to move forward. And we will, obviously, we've been there around for 159 years, including in China and Hong Kong and a number of other countries. So if our customers and ourselves need to tough out a year or 2 years of adjustment so that the economy puts itself on a materially better forward-looking track, of course we'll be here for that and we'll tough it out.
Let's help investors out on the property side, because your CEO, Noel Quinn, said in October last year the real estate crisis had likely bottomed out. Yet just a couple of weeks ago in the numbers, you reported China-related impairments, $3 billion on China Banker Communications, your stake in that thanks to an accounting rule. So how much more tough news do investors need to get through when it comes to the property market in China?
I think, again, most of the challenges on the property market in China are behind us, but that doesn't mean the sector is out of the woods. It still means the sector is working its way through in various forms, probably next few quarters, to get out of the challenge. We think the worst is behind us. We think the trough of that sector is behind us. We think in our case, our exposure and our ECL covers the bulk of the charges behind us, but that still means there will be lingering effects as the sector continues to adjust, and we may continue to see some impact, but not to the tune that we've seen last year on our credit charges.